On today's show, 3 questions. Number 1, did data throw the Fed under the bus? Are stocks risky? And are you sick of student loans yet? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Taylor.
And I'm Rabih.
Welcome, my dudes.
What's up?
How are you?
Oh, good. How are you?
I am hesitant. I'm hesitant. That's
what are you hesitant about?
My audio. I'm too afraid to jump in here.
Taylor's so nervous about his audio. He doesn't want to respond to anything. And even to hey, how are you? He's like, I don't know. Okay. Well, rocky start, but here we go. We're gonna finish strong. Okay. Number 1 question: did data throw the Fed under the bus? Rabih, tell us if they did.
Yeah,
or if the data did.
Honestly so interesting. I don't know. Maybe I'm the only one who's going to be excited about this. But for the
Never true. I get jacked up on your segment every time.
Okay, thank you. I appreciate it. So the idea was earlier in April, we talked about how the Federal Reserve issued their summary of economic projections, right? And they were saying that they expect the GDP in 2024 to grow 2.1%. This was kind of a surprise for, people who are not the Fed, because they thought that now the GDP growing at 2.1% is above average growth. And this suddenly means that not even a soft landing scenario is going to be taken into consideration, and the economy is just going to cruise control slightly above trend. And, it's la vie en rose. It's the best possible scenario out there. And then estimates for Q1 of GDP for 2024 came in.
Wow.
Those estimates, this is the first out of 3 estimates. So it's going to be a while. There might be some adjustments. But on annualized terms, aka they took what the quarter is and they multiplied it by 4, it did not come anywhere close to the 2.1% they're talking about. It came at 1.6, which is a decently amount that's below target and would highlight soft landing scenario again. It's not a recession. It's positive. It's 1.6% annualized, but it would highlight a soft landing. Reaction, the market is kind of volatile these couple of days simply because earnings are there. So there are multiple sources of noise that are moving prices up and down. But when that news came out about, a slower GDP growth than anticipated, the market actually continued its sell-off that we talked about in last week's episode.
Hey, Rabih.
Yeah.
Do you think there's high school kids out there right now when their GPA, their scorecards come in lower than expected? They're now making the argument to their parents this is just a soft landing. Hey, listen, mom and dad, yeah, it's slower than you thought, but so did the GDP. The GDP was lower, and we're just trying to soft land this thing.
Dude, I hope not, because then I missed out on a great opportunity when I was a kid.
Right? So I was just sitting here thinking, man, this should have been a valid argument, I feel like, back in the day.
But yeah, and it's all about expectations, because even the Fed is at the mercy of falling to this mishap. If you're a student, let's go back to common sense away from finance for people to intuitively think of it. If you're a kid, you exited an exam, you don't know, it's the first time you got introduced to this material. This is an analogy of having inflation for the first time in 40 years. And then your parents tell you, hey, how did you do? You don't tell them I'm going to have a perfect score.
Yeah.
This is what the Fed said in the last summary of economic projections. It's the GDP is going to grow 2.1% regardless of all the, gymnastics economically we've been having for the last two and a half years. So
here's what I love about this. I just threw out a horribly stupid, off-the-cuff, shooting from the hip dad joke, and you took that and you wrapped it into something that actually made sense to help people understand what's happening with the Fed. That is the definition of brilliance. So
thank you.
Congratulations.
Thank you.
It's amazing.
Thanks. I'm glad there are no sound effects.
I wish there were.
So the idea is that now, we're getting grounded again away from Fed expectation and just being data dependent, as they like to call it, looking at an economy that if you annualize the Q1 data, is growing at 1.6%. Unemployment, it's stuck at its 3.8% level, which is low and would not help you in your fight against inflation. And inflation that's been trending sideways since the beginning of the year, although it did a lot of positive progress in 2023. So this is where the Fed is at right now. And we will see in May, next month, when they meet, given this new data, how they're gonna change their stance. And I guarantee you, I'll be like following them line by line, word by word, to tell you how they're gonna be softening their tone. The market, as I said, multiple sources of noise have been reacting a lot. But there could be an argument made that there was a slight overreaction, because when you are thinking of 1.6%, the actual, that's annualized, the actual number is 0.4% growth quarter over quarter. The economy grew by 0.4%. If you wanted a target growth, which is 2%, it means that the economy every quarter, if we assume that all quarters are going to be the same, is going to be growing 0.5%. So yes, between a 2 and a 1.6, it's a very big difference. It's
on a quarterly basis.
But on a quarterly basis, it's between 0.4 and 0. And like all we need is Q2, Q3. If the Fed comes in May and they double down on, yes, we think the economy is going to be growing 2.1, this just indicates that now Qs 2, 3, and 4 have to be growing at above 0.5, right? So on average, the economy is growing at 2%, which is honestly a double down on the bullish sign. And the idea that the market now is in a slight sell-off due to uncertainties, geopolitically, earnings, etc. As we talked last quarter, this could be a good dip, for people who do not want to cost average. That's where we stand. And
did I just hear a subtle buy signal from you? Like buy, time, buy. Are you going to start throwing out some stock symbols here?
Honestly, if we had the budget of Jim Cramer, you'd see me with a baseball bat smashing
things. Yeah,
telling people to buy.
Would love that. Yeah.
But honestly, our audience are mainly long-term investors. So every episode, whether the market is up or down, their recommendation is always going to be buy. Although this podcast does not have any investment advice.
Yeah, not investment advice.
Yes.
Consult with your advisor. Okay, great. Was there anything else you wanted to hit on the breakdown of the GDP? I do have a question, but let's break this down, and then I do have a follow-up question.
Yes. So the 1.6 growth, just to give you something to compare to, I'm just going to compare it to what happened in Q4 2024 when the GDP grew 3.4%. We're all happy. Around 65% of that 3.4 in Q4 was from consumers, and the government contributed like 23%. And then our imports and exports and like investment from companies contributed 11%. So it was spread out. You've got 65% from consumers, 23% from government. It was a mix. If we look at Q1, it doesn't look as equal. It is very weighted, and it shows you that the economy might be in a less robust positioning compared to the previous quarter. Out of those 1.6 annualized growth year over year for the GDP, quarter over quarter annualized, my bad. The consumers actually contributed 1.68. So the consumers as a whole, if you just take the US consumers and you say, oh, this is the economy, I'm going to exclude the government, I'm going to exclude the businesses, I'm going to exclude our net import exports. Consumers as an economy by themselves grew 1.68. They grew more than the 1.6, which means the other portion,
so it was all of it.
Which is like 1.5% of the 1.6. So it's all of it. All of the growth we've seen in Q1 is mainly coming from consumers instead of only 65% of it last week. So the consumers as spending is really what's keeping the economy afloat at the moment. So given that this is above what the GDP is, it just means that the other three portions kind of didn't contribute or contributed negatively in a sense. And actually our net exports of goods and services was down, like contributed negatively by 0.86 to the GDP. So it dropped us from the 1.68 down to the even below the 1.6 because it contributed negatively. This is a factor that we have exported less and we keep on importing because we like spending. This is what
we love to spend money.
So from that sense, we're there. The government also, mainly state and local government, not federal government, spent less this quarter, which also contributed to a lower number. However, on the good side, although it's still low, private domestic investments, which is what businesses are spending money on, which is usually a leading indicator for the economy, actually ticked up. It was 0.15 in Q4 from a contribution perspective. Now it's 0.56 from a contribution perspective, which if you subscribe to the idea that businesses are always trying to anticipate what the demand is so they are ready in time for consumers to spend, they would start investing in their infrastructure, in their inventory, et cetera, ahead of time. And this is a good sign, a leading indicator to the GDP.
Got it. This is all great stuff, Rabih. I'm curious, as we go through this, obviously we talk about we want to inform people on this. We want to help navigate the noise, as we always say. I'm sitting here thinking as we're going through this, I'm like, where's the balance here of just getting too much data thrown at us from the Fed, or just all these little different components and things that we're like, at what point does it start to work against us? Like, we're reacting, like, meaning we as in like society, the market, like we're reacting to so much because there's so much data out there. You and I have talked about this, right? Of the history of the Fed, and even the history specifically of the Fed doing these press conferences, right? You and I have talked about this. I don't know if we've talked about it specifically on the show or just when you and I nerd out. So I don't remember, but I know we've talked about this. And this is more just opinion. Like, where's the balance here? But sometimes I'm like, man, there's too much. We're tracking things daily and we're breaking things. I'm not saying we as in 2 cents. I'm saying the Fed and all this stuff that's coming at us. A lot of it feels like just straight up, it is just noise. It's like, there's no way all this matters.
Yeah, this is a really good question, and there are actually it's a two-part answer. There are 2 parts for the answer. The first one is more global. It's more macro. It actually relates to our life. I'm just gonna take the example of sports. We used to watch basketball, and all we cared about was points, rebounds, and assists. That was it. And now, if you look at all the metrics that we look at, minutes played, steps taken, elevation of the jump, efficiency ratios,
all the analytics.
All the analytics. It's just has become more concentrated where you can extract more data, and it happens even quicker. Like the pace of it, I can think of the example. I'm a little bit of a history nerd, so I was like watching some documentaries about US presidents, and like presidents would disappear for a couple of months and then come back and make one speech and then disappear for a couple of months. If this happens now, people would lose their mind, right?
Yeah,
because you want constant information coming in. So whether it's in sports, whether it's in politics, and also in economics, our life has been trending towards a pace which is so rapid, instantaneous access to information. And the Fed is just within that wave, in a sense. That was one part of the question. The second part of the question is related to I would say, between quotations, the newly discovered role of expectations when it comes to monetary policy. So the Federal Reserve can go up and say, our target is 2% inflation. We're just going to increase interest rates when inflation starts showing up, and decrease interest rates when unemployment starts showing up, and just go home and not say anything else. When the Federal Reserve goes up and says, our target is 2% inflation. However, we know that policy might work with a lag. We know that market participants, aka investors, would react in the moment. We're going to start communicating our expectations and let them start pricing it into financial instruments ahead of time. And it would actually do some of the job for us. So it's very interesting. Back in the 70s, the Federal Reserve didn't do those monthly press conferences. They met every month as a committee. That they never did the press conferences. Those press conferences started showing up during the Greenspan era in the 90s, etc. So back in the 70s, they weren't really portraying their expectations much. They're just saying, this is the policy we're coming up with. I do acknowledge that inflation in the 70s was much worse than what happened last year, but still, they had to go on multiple waves under Volcker, increasing interest rates up to like 16% just to handle and take control of inflation. If they have done the same right now last year, maybe 5.5% could have been too low. Their policy wouldn't have been as successful had they chosen not to communicate ahead of time.
Got
So
it.
the second point of that answer is like a lot of the Fed communication and them being in our faces the whole time helps them do their job better because it sets expectations. If it wasn't there, it would have been a different story. And this, and like just from an academic narrative, has been there since like the early 2000s. Like, yes, the Fed, if they convey information more and they become data dependent and they bombard people with statistics left and right, it's not to distract us and to dull us, but more of because it has a residual impact on how financial markets work.
Yeah, no, that totally makes sense. So what you're saying there is that it's a balancing act, right? It's part of it is just the, like you said, the macro environment we live in. And I love the sports analogy. You look at social media, you look at politics, you look at all of this stuff. It's all kind of the same. It's just the environment we live in, of this connected world we have and the amount of data and information that's out there. But I hear what you're saying. The second part of this being, it's also a good thing. It also helps smooth the ride out and helps communicate and ease tensions, possibly by just communicating rather than keeping it ambiguous and people having to interpret things on their own. So that totally makes sense. I just think there's got to be a balance here as well, because part of this is just, a lot of this is just noise. And, you know, like you just said earlier, you're talking about this number that comes out, the 1.6, and we start to overreact to it based on the previous communications. And anyway, so I don't have an answer here, just more saying, I think it's worth acknowledging the amount of data that's always coming at us and being like, most of this probably doesn't matter. And especially to what we always say from an investor standpoint, you're a long-term investor. A lot of it, 99% of the stuff doesn't matter.
Yeah.
We do want to inform and hopefully set an expectation and help you, again, navigate the noise and just realize, like, we want to inform you, but also, like, move on with your day now. Like, you know, like, be informed. Don't make any decisions based on this when it comes to investing. So, Rabih, anything else you'd say? And we also got to do a check in on Taylor, make sure he's there. Taylor, you alive and well?
I hope I am.
Okay. For context, Taylor has some technical difficulties. He's had some over the last few recordings we've done. And I think it's maybe messed with your psyche more than anything, Taylor.
I am a complete shell of myself.
The unfortunate truth is you have to turn your camera off to help with the recording, and we don't get to see you. But okay, Rabih, anything else you add on any of that?
No, we'll see you next week.
Okay, perfect. That was awesome. We're going to move on to the next question here. Are stocks risky? So this actually was from we wanted to circle back on this because we made, I don't know when it was, but a few weeks ago, we talked about, and I've said this many, many times, I stand by this, that stocks are not risky, and we'll dive into this a little bit more, but we got a comment because what we did is we took our clip from our 2 cents from, again, a few weeks ago and posted it, and we had a response. We had a comment, and from the Educated Associate, on Instagram. So the comment was, individual stocks have always been and always will be risky. Also, obviously, 100% of stocks, in quotations, don't go up over 20 years. Some companies will and did go bankrupt. I believe you're referencing index funds rather than individual stocks. And in that case, I couldn't agree more that index funds are never risky in 10 to 30-year windows. So, Rabih, I know you got thoughts on this, but just for further context here, really briefly, the comment made, to paraphrase, that we made was that stocks are not risky, and that oftentimes when people talk about risk with investing in stocks, they're really referring to just uncertainty and the short-term ups and downs that come from investing in the market. But over a long enough period of time, you zoom out far enough, and stocks are not risky. So that was what the comment, that was kind of the essence of the comment, and then that was his response. Rabih, I want to give you first word on this, and then Taylor, I want to hear what you have to say as well. What is your initial response to that?
preach to the choir.
Yeah.
Yeah. You're not wrong. You're not wrong.
Yeah.
You're not wrong.
Yeah. I read it to Rabih earlier before we started recording, and Rabih's like, yeah. Kind of like,
He is right. He is right. And when it comes to comparing the risk of just being in an index versus the risk of being in an individual company, this has been proven myriads of time when it comes to practicing or when it comes to academia, that diversification, adding multiple stocks to your stocks portfolio, will diffuse away idiosyncratic risk, which is company specific risk. And in that sense, you have a better chance of turning your portfolio into a metric that benefits from survivorship bias. This is the idea of being in an index. And it works. It works mathematically. It has worked through 100 years of practice. It worked. That realization actually transformed the industry with, Vanguard funds, as a sense. They were the first Bogle's funds, because what happened, they introduced the index tracking funds, and instead of just having a bunch of active managers cherry picking stocks and turning them over every couple of weeks or days when they heard new information about the stock, it was like, hold everything and forget about it. And you'll notice that your portfolio is less risky than if you were trying to create a portfolio on your own and trading in it more frequently. So yes, unfortunately, this idea of diversification, although it's very old in the investment industry, it's not really an innate piece of knowledge in everyone's mind who are not exposed to proper financial education.
Yeah.
So we keep preaching the idea, but hopefully in due time, it's just going to be the de facto answer.
Yeah. Taylor, what are your thoughts?
Yeah, I think this kind of goes back to like good general advice is bad specific advice, right? And when you basically, your point when you made it on the podcast was not that all stocks go up, right? That was not your point. You just said, hey, stocks aren't risky. But when you say stocks, you're not just saying stocks in general, you're saying well-diversified portfolios that are held for the long term, right? And that are managed effectively, right?
Yep.
And it's the same thing.
That's a lot to say, though. It's a lot
it's
to
a
repeat.
lot to say. It's not very catchy. It doesn't look good on a podcast headline, right?
Exactly.
And
We're
it's
all
the
about
same
catchy.
thing with this guy's comment. You can drill down on his comment, right? You could say, hey, it's not just buy any index fund. It's not all index funds go up over 10 to 30 year periods. It's like, do you actually have a strategy involved? Are you picking the right amount of the right index funds that follow your specific asset allocation that you're targeting and your time horizon and your investment goals and, you name it. So the more general you get, the more incorrect your statement will seem at face value.
Totally.
Right? And that's kind of what I got from this is like, you can continue to drill down on anything, which just kind of leads me back to the point of like, just don't follow general advice with your plan. If you want to have a really well thought out plan, spend the time, get specific advice, make sure that you've put in more than, a couple seconds of thought into it.
Yeah, I think my general takeaway, my default is usually like, just don't listen to me. It's probably just a good takeaway from this. But to your point, Taylor, very well said. And I will give you my intent when I say this. I will tell you exactly my intent behind this, which is I want to change the perception. The common perception and default is that stocks are risky. Like I think if you ask most people about stocks, their default would be, yeah, stocks are risky. And so I try to push back on that by saying they're not risky. And it's almost, I fully admit it, it's almost a way for people to like perk up a little bit, but like, well, what do you mean they're not risky? And then you can hopefully have a bigger conversation around it. So I genuinely stand by this. Stocks, and then we'll go parentheses, a well-diversified portfolio over that's effectively managed over time are not risky, right? To your point, Taylor. Yeah. We could get into the details of business-specific risk, right? Geopolitical risks, regional risks, depending on politics and all this kind of stuff. But I will say stocks are not risky. Stock picking is risky.
Yep.
If you're going to go and pick individual stocks on your own and try to time things, and absolutely individual stocks have, as this person says, have and will go bankrupt. That is, if you just look at the composition of the S&P 500 over the last 100 years, go look at how much turnover there's been within that index. Individual stocks, I don't know the numbers exactly, Rabih, you can correct me if I'm wrong, but it's like well over 50% of what it used to be 100 years ago is no longer in the S&P. So, and a lot of those stocks have just completely gone away. So individual stock picking, absolutely risky. But I also think, and we don't need to spend too much more time on this, we need to move forward. But the other part of this, I would say, is what are we defining as risk? That's also what I push back on with people is when you just say risk, like there's so many different things we need to break that down. Like we need to break down from that. So again, are we talking about volatility? Are we talking about uncertainty? Are we talking about individual business risk? Are we talking about like, there's a lot of like permanent risk of loss, like what opportunity cost, like what risk are we talking about? And Taylor, to your point, this is why you've really got to get specific to truly start executing on a plan as opposed to just listening to general advice. So I'm going to give you guys last word on this. Any other thoughts or comments on any of this? Did we give the educated associate his fair due, and we didn't want to roast anybody. We just we thought this was actually a good comment. We wanted to have a conversation around. We were, we're not trying to be mean or anything. So yeah, I think we did.
I don't think we were mean. I think
we were really nice. Like we're nice guys. We're nice guys.
If anything, I think we just said that Matt's basically Dave Ramsey, just spewing out general advice out there.
I think that's what we just discovered is I'm Dave Ramsey. I wish I had Dave Ramsey's net worth, and then I would be fine with that comparison. Okay, let's move on. Finish this up. Number 3, are you sick of student loans yet? So we talked about some student loan stuff last week, but we didn't have our resident expert on the show with us, which is Taylor, and we wanted to hit a couple of specific things, not around what we talked about last week was Biden's kind of proposal. His second kind of go at his proposal of forgiveness. But Taylor, you wanted to get more specific on some stuff. So I'll throw it to you to hit this.
Yeah, I think the answer to that question is just yes. And we could probably just end the podcast, right?
Deal. Perfect.
The answer is yes, we are.
Thanks everyone for coming. This was awesome.
No, I wanted to bring up 2 key dates and kind of talk about these. One is very sensitive. One of these dates is April 30th. And by the time this podcast comes out, it will be April 29th.
Yeah. So if you're listening to this tomorrow is the deadline.
Yes. So what really prompted this or how this came about is I had a client who emailed me and said, I just heard about the IDR waiver. Do I need to do anything? Right. And I was like, IDR waiver, what is that? Well, this used to be called the IDR waiver. They're now calling it the IDR account adjustment. But basically, how this came about, there was a famous stat that came out in April of 2021. And this is after decades of repayment. Do either of you know how many actual loans were forgiven after decades of repayment as of Apral 2023? Rabih, you have a guess?
4.
Don't you try to big time me, Rabih.
You guys are on it though. There were 32 people that had their loans forgiven.
You're closer than I thought. I was just having fun with it.
So despite millions and millions of people borrowing loans, making decades worth of payments, as of April 2021, only 32 people had achieved actual loan forgiveness. And there were so many reasons for this, right? But basically the long story short is the program was just flawed. The federal government didn't know how to count years of credit. I mean, there was just so many things that were not working. So basically, if you were an IDR plan, if you were any type of repayment plan, you were not getting credit for your actual loan payments. And so this IDR account adjustment was something that Biden proposed and is basically a way to go back and give past credit for all of the loan payments that you've made, right? And they've been doing that throughout 2024. 2024 is the year that they've been going through and going back and granting actual credit for payments that you've made. Now, it's been happening in waves, and that's why, the most recent wave actually came out earlier this month, and there was like close to, let me just pull up the article, but it was, I want to say several $1 billion, $49 billion in loan forgiveness qualified as of April 12th. So it was a really, really large forgiveness, and it was such a large headline that some people said, oh, this hasn't happened to me. Well, don't worry, it's still happening. It will continue to happen through 2024. Basically, what's happening is the federal government's going back and they're adjusting all accounts to give past credit where credit is due. So the question which my client had was, do I need to do anything, or do you need to do anything
by tomorrow?
So for anybody that wants or has loans that were commercially held, FFELP, Perkins, or health education assistant loans, those need to be consolidated by tomorrow, April 30th, in order to count for this program. So this doesn't affect everybody. This just affects people who have probably had loans for a while. If you have any FFELP loans, Perkins, or health education assistant loans that you would like to qualify for this program, those need to be consolidated into the federal direct loan system by tomorrow, April 30th. Right?
Got it.
For everybody else,
get working,
you don't
everyone.
Need to worry about it. You don't need to worry about it unless you are. I mean, if you're looking to qualify under PSLF, which is the Public Service Loan Forgiveness Program, after 10 years, you get it all forgiven. You do need to fill out your employment certification and a PSLF application, but that's not an April 30th deadline. That's just sometime this year. And then anybody that wants to see this account adjustment happen, you need to make sure that you are enrolled in an income-driven repayment plan, right? So if you have been in deferment and you didn't realize that you weren't put back on an IDR plan, you just need to make sure you are on an IDR plan. If you are, this account adjustment will happen without you doing anything. All right. So that's date one. Date two that's important is July 1st. Now, I talked about this on our most recent client only huddle, but I wanted to bring this up here. This really only applies if you have loans dating back prior to any loans you took out prior to 2014. So again, for borrowers that have been paying for a while, if you have loans that were prior to 2014 and you, for whatever reason, got on the SAVE plan, well, if you're considering going back on pay to shave off 5 years worth of payments, that has to be done by July 1st of this year. If you are still on SAVE by July 1st of this year, you are no longer eligible for the pay program. You cannot switch back to the pay program, and you cannot switch to an income-based repayment plan either, IBR, right? Still can be on an IDR, still can be on SAVE, but if you are hoping to shave 5 years off that time horizon and get back onto pay, that has to be done by July 1st of this year.
Got it.
So again, if you're listening to this and you're confused by those, welcome to the club. But my hope is if you have those specific loans and you heard those loans, that was helpful to you. But for most people, this shouldn't affect them. You should just, hey, if you're on an income-driven repayment plan, you're going to get the account adjustment. If you've taken loans out after 2014, there's no real big worry or imminent date that you need to be paying attention to.
If you're listening to this the day it comes out, the deadline is tomorrow. If you're listening to this on like a Wednesday or Thursday, it was yesterday or the day before. So yeah. Sorry. And then July 1st is the other big one.
Yeah. And honestly, that April 30th date, not a lot of people have FFELP loans, Perkins, or
I was going to say, I don't think this is very common. Yeah.
It's not very common, but I wanted to just get it out there.
The URL, the link is for that. It's dentistadvisors.com/loans. Is it student loans or loans? Just loans. Okay. Yeah. Dentistadvisors.com/loans. If you want to set up a consultation or just talk to us more, or I think you can submit a question even through the portal there. So awesome. Okay. So the question was, are you sick of student loans yet? The answer is yes. But also there's important stuff to be thinking about. Awesome. Okay, guys, any final words, any final thoughts, tidbits, anything you want to share with the people?
No,
Okay.
I mean,
He does. He wants to. Go ahead, Taylor.
What I was going to say is friend of the pod, Travis Hornsby. I love his analogy. Every time there's an update with the student loan program, they don't get rid of the old programs. They just add another layer. So again, this is just a sandwich that just keeps getting larger and larger.
Which normally I like.
Ingredients, with more and more ingredients.
Yeah.
So instead of being like a really good Jimmy John's, it's becoming a Subway sandwich with way too many ingredients.
Taylor, you're going to end the show with this. You're going to try to start a fight at the end of the show. I'm not going to bite. See what I did there? I'm not going to bite. So you like that, Rabih? Okay. We're going to fight off camera. You're already off camera. We're going to fight off the air. Okay. Thanks, Rabih. Thank you, Taylor, for being here. We're going to do final plug. I shouldn't say final plug. Another plug, as always, Dentist Money Summit. We are 2 months out, guys. Check it out, dentistmoneysummit.com. It's starting to feel real. It's starting to feel real. The planning is getting more nerve-wracking on our side, I'll say. We're just starting to get more into the details and the weeds and start planning things out. We are so excited. We'd love to have you there. Bring your spouse or partner, bring your family. It's an incredible place. It's at the Grand Summit in Park City. There's going to be golfing. There's going to be mountain biking, hiking, and also some incredible speakers and a way to earn some CE. So check it out, dentistmoneysummit.com. Thank you, everyone, for listening. That was our 2 cents. Have a great week.